Sounds like we've got a diverse group of individuals on here, some of them that are potentially launching Fund 1, some of them, like Allison, on Fund 3. So figured I'd talk about a couple of things that you should be thinking about as you go through the launch process, specifically as it relates to your audit and tax provider. So as I mentioned before, we have a very large focus specifically on emerging managers. And I put together some of these bullet points, just going back, thinking about some of the things that other managers have asked us in the past, or issues that other managers have dealt with as they were launching their funds. So a couple of high level points. Timeline is really important. A lot of times, we get in well after the manager has begun discussions with their attorneys and their other service providers. And what I always like to tell people, the earlier you can get your audit and tax advisors involved, the better. The reason being, we can sit there, we can take a look at your draft documents, whether it's the LPAs or otherwise, and provide you with any sort of high-level insights that we have, whether it's structuring or if there's something that's different from what we're seeing out there in the industry. Just really more as like an informal guide. We can help you guys out as you guys are launching your funds. So my point there is always, as early as possible, getting the audit and tax guys involved. Specifically on the tax side of things, the audit is largely a compliance exercise, but from a tax perspective, you really want to make sure, because that actually has an impact to the bottom line or an impact to your investors. So getting it structured right initially is important. And the sooner you get the tax accountants involved, the better that process is going to be. The other thing that I like to kind of point out as well is, as you guys are setting up your LPAs, a lot of times you'll put in deadlines for when you expect the audits to go out. In the VC space, we primarily see 90 days. For funds that are registered or managers that are registered with the SEC, it's 120. And then obviously on fund of funds, it's 180. I'm always a big proponent of taking, or at least when you're putting it in your documents, putting as much time as you can possibly have. Not suggesting that the audit will go all the way to that 120-day deadline, but really putting that 120 days is a good idea as opposed to 90, in my opinion. That being said, we can certainly get audits out sooner or later as necessary, but it's an important thing that people sometimes overlook is the deadlines that they're putting in their LPAs for the audits. And while it's not the biggest deal if you kind of miss a deadline, maybe 1 year by a few days, but that being said, certainly with LPs as they're investing in Fund 1, the less issues you give them, the better. So just being cognizant of what deadlines you're putting in your LPAs is super important as well. And then finally, kind of coming into the audit execution phase of this is once everything's set up and the auditors are in there doing the work, the one thing I'll recommend is definitely keeping regular touch points with the audit and tax providers. As you guys are getting into new investments or you're looking into something that's outside the normal course of business, you want to make sure that the auditors and the tax guys understand what's going on. We're certainly more than happy to provide any advice or any guidance or anything that we've seen to help you navigate that. And then, valuations, when you think about it from an audit perspective, valuations, and Ava can probably, attest to this as an administrator, she'll probably deal with this a good amount as well. But when you think about it from an audit perspective, your assets need to be fair valued. And that's probably the biggest piece of the audit where we spend the most of our time. And that's typically when you run into issues. If you've heard about a fund or you've had a fund in the past that's gone past the deadline, there's a good chance the biggest issue there was valuation. So once again, I recommend starting that process as early as possible. I typically like looking at Q3 valuations going into year end. Certainly at Withum, that's our sort of go-to method is making sure that we've addressed all valuation questions in that October, November timeframe, well before we get into year end. That way, if there's something that we're not comfortable with or something that's outside the norm, we can kind of provide you with that feedback, and then you can adjust those valuations going into year end, which makes the audit process and the timeline a lot smoother. So if there's one thing that I'd want to stress on this on these points is making sure that you're speaking with your providers on valuation as early as possible. It is going to be the biggest piece of the audit. And the last couple of things, really the information from portfolio companies as you guys are launching the fund and make those investments. I know in the VC space, as opposed to private equity, one of the biggest challenges we face as auditors is the information. We have very little information coming in from these portfolio companies, especially if they're a newer company, just launched pre-revenue. It's very hard to get decent financial information from them. So one of the things to kind of, I always like telling my managers is a lot of these companies are not willing to share this information with third parties such as auditors. So as much information that you guys can kind of keep and document on your end is going to be really, really helpful when it comes time to getting these audits done. Like I said, we don't always get this information from those portfolio companies. So to the extent you guys have it and have it neatly organized, it's always a good fact pattern for us. And then the last piece really is, I'm a big proponent of, you can certainly have a different audit and a tax provider. That being said, the process is a lot more seamless when you have your audit and tax providers being the same firm. Ryan's a tax partner, I'm on the audit side. And anytime I'm going through the audit, which typically starts before we get into the tax work, if there's something that I know is going to impact Ryan's work, he's usually a phone call away or a quick message and say, hey, watch out for these things. This might be an issue. Or to the extent we have any adjustments to the numbers that we know are going to impact the taxes and the K1s, I want to make sure Ryan knows that as early as possible. And obviously that's a lot easier when both the audit and tax partners are at the same firm. So just something to consider. That doesn't, that's not a be all end all, but something to think about. And the last piece is, I'll share with Joel after this call. Withum puts together, we have a pretty good emerging manager guide that goes through a lot of different points to consider. It's a little bit broader, not focused specifically on the VC space. It's focused primarily on private investment funds. So structurally, no different than a hedge fund or a private equity fund. But there is some helpful guidance in there that I'll share with Joel, and hopefully he can share it with the rest of the team. So I'll let Ryan take over from here on the tax side of things.
Yeah, thanks, Kuber. So just real quick, two items and maybe mistakes that we kind of see on the tax side. And when I look at tax in the VC space, I kind of look at it from two different angles. There's an external piece, but then there's also an internal piece, right? And the external piece is where the majority of the folks. So that's your external LPs, right? So that's trying to make sure that you're getting your deliveries out for the K1s for March 31st. Also making sure that the investments that you're making aren't going to trigger any negative tax impacts to your LPs. So that might be investing into an LLC, that might be generating some ECI. So that those are generally things that we want to avoid. But the internal piece, I think, is just as important. I think that's where a lot of the mistakes get to be, from a tax perspective. And so when we look at it, everybody here, I guess, has a different, walk of life of how you kind of got to this position. And some people, are used to working at a fund, and you're a W-2 employee of that fund, or you're at a portfolio company launching your own fund. And, the difference is that now that you're running your own fund, you're considered a self-employed, right? So from a tax perspective, you no longer have a W-2 where you have withholding coming out of your paycheck. Instead, you are now the sole responsibility to pay quarterly estimated taxes with the IRS. So that's something that we see commonly get missed from an individual perspective. And then the second piece is just the management company structuring. And so, right now, especially with Fund 1, a lot of you might be starting out as a sole GP, so you're managing the entire thing by yourself. And the management fees and all the activity are then generally going to go to your personal return. And there's ways to structure that so that doesn't happen, because depending on what state you're in, There could be some really good tax savings from a management company perspective if you create a separate management company with the second member, because we're able to elect into what's something that's called a pass-through entity tax. And basically a high level pass-through entity tax, without getting into too much details, is that instead of all of the management company activity go to your personal return, and that's where you're going to pay taxes, especially state taxes at. Those state taxes, if we create a separate management company, are going to be taken at the management company level. So the management company is ultimately going to pay your state taxes on your behalf and take a federal deduction for that amount. So when we're able to do that, we're able to reduce your federal income tax from a partnership perspective, and then that will flow to you individually and will get statement taxes from that perspective. So just from a tax side, again, just to kind of summarize, and I'm happy to have a conversation with anybody afterwards, but just structuring, especially around the internal piece of it, is extremely important to get right up front. And that way we might be able to save you some real tax dollars at the end.